Hi folks, time to take a look at chapter 4. So what we're going to take a look at here have adjustments. That's the big part of this chapter, okay? Why do we make adjustments? How do we make them? All that kind of good stuff, okay? All right, so the first thing, why are adjustments needed? Like what are these things? So let me give you the big picture first. So remember, we need to make sure that the revenues and the expenses match, right? Well, all during the month, generally during the month, we're doing transactions, but there's some items that we have to make at the end of the month. We have to make minor adjustments to make sure that the revenue and the expenses are in the right period, okay? That's what these adjustments are all about, okay? They usually have to do with an expense that hasn't been put in place yet, or has to do with an expense that hasn't been put in place, or it has to do with an asset that's being used up. But anyway, just follow through with this and you should be good to go. All right, so again, accounting systems are designed to record most recurring daily transactions, right, which is due, okay, particularly involving cash. All right, well, that makes sense. However, cash is not always received or paid in the same period. Like we've seen that before, right? So what happens is we wind up having to make some adjustments. And basically that's to make sure, so most everything happens during the month, but there's always periods at the beginning and the end where you have to make these, actually at the end where you have to make these adjustments. So for example, on the income statement, thing to keep in mind, revenues are recorded when they're earned, and expenses are recorded in the same period as the revenues to which they relate. So remember, we want these, this is revenue recognition, and this is also the matching principle. Okay. The balance sheet, assets are reported at the amount representing the economic benefits that remain at the end of the period. Now we'll talk about that one. That was a little bit more confusing, but you have an asset, and some assets they're amortized or depreciated over time. And again, liabilities have to be reported correctly as well. All right? So, why do we make adjustments at the end of the accounting period? This is question number 1 for chapter 4. Okay? So hopefully after what I just told you there, you should be able to answer that question. Make sure you write it down so you could have it ready for your quiz. Okay. All right. Why do we do them all at once at the end of the period? Okay. I might not have mentioned this one, but it has to do with being efficient. Like we don't do them all through the period, we only do them at the end. So I'm kind of going to give you this one because I should have mentioned this before. It's simply more efficient to do them all at once. Not to mention, making sure you follow a process each time. That way nothing gets left out. Okay? So there you go. That's a gimme. All right. So the first one here, let me put all this stuff up here. They call these deferral adjustments. Okay? And this is an expense or a revenue that has been deferred. Deferred means that you're going to deal with it later. Oops. What are you doing? Why did you do that? Zoom slideshow. Okay? And postpone an income statement until a later period. So here's an example. Okay? So here's an example. On September 1st, we paid cash for rent in advance, right? Then we use up the rent benefits, right? And on September 30th, we have to make an adjustment. So in other words, if we paid $7,200 prepaid rent for 3 months, it's going to be $2,400 a month, right? So we make that adjustment at the end to lower that prepaid rent amount because the rent was used. So it's going to go from an asset to an expense. Here, the same thing, cash received for subscription in advance. Now, in this case, we're like the magazine company, right? Then we deliver the magazines, and then we need the adjustment. So let's say somebody paid $120 for 12 issues, right? That's $10 an issue. Now, we receive the money in advance, but we can't count it as revenue until we actually deliver the magazines, okay? That's what it's about. So here you go. What type of account would prepaid rent be? Prepaid rent. What type of account would prepaid rent be? We've seen this one a couple times before. Okay? All right. Now here they kind of, not my favorite slide here, but what they're saying is that there's some sort of adjustments that happen. So for example, here's a couple of examples. On the balance sheet, right, you have supplies. Now supplies are an asset, and then when you use them up, they become supplies expense. Okay? Same thing, prepaid rent. Prepaid rent is an asset. When you use it up, it becomes the rent expense. So this is like we paid for it ahead of time, now we're using it up. Same thing with prepaid insurance. Let's say you paid $1,200 for insurance for a year and you're in business. Well, you don't want that $1,200 to be all in one month, so what you're going to do each month, you're going to charge off $100, so that $100 is in each of the 12 months, and then it's called insurance expense. Okay? And then over here we have deferred revenue. This is like the magazines, or if we have, like Delta with the airline ticket, where they have the cash, but they haven't given you the service yet. And then it becomes sales revenue or service revenue, because here they hadn't earned it yet, but now they're going to earn it. Okay? So, what type of account is supplies? Just mentioned it there. Hopefully you're paying attention. Just mentioned it. Again, mark this down. Going to have a little quiz about it. It's going to be on Canvas. Okay? Okay, now accrual adjustments, they're a little bit different. Okay? Accrual adjustments are needed when a company has earned revenue or incurred an expense that has not yet been recorded. Okay? Not yet been recorded. All right, so for example here, okay, let's say for argument's sake here, we incur income taxes, so we have an expense and we need an adjustment to be made. Okay, so there's some kind of tax here. And the same thing with the bank. Let's say September 1st, we have our bank account. Then we earn some interest. Well, we have not recorded that yet. We don't know what the interest is till the bank tells us. Okay, and then at the end, we make the adjustments for these. Okay. So again, here they're talking about these accrual adjustments. So notice, on a balance sheet, you have what's called interest receivable, meaning you've earned it, but you haven't received it yet. And then once on the income statement, the adjustment is to interest revenue. Same thing on a balance sheet, rent receivable becomes rent revenue. So basically, this is where we have not yet put the item on our books, and we need to put it on it because we've wound up earning it in some capacity. Same thing here, income tax payable becomes income tax expense when it's paid. Wages payable becomes wages expense when it's paid. And interest payable becomes interest expense when it's paid. Okay? By the way, it's a little confusing here, but once you see them done, it'll make more sense to you. Okay? So let's take a look at some of these. Okay? So notice, adjustments are not made on a daily basis. It's more efficient to do them all at the end of each period. By the way, this is where that question should have been, right? Should have been right after this. So the idea here, you analyze first, then you record, then you summarize, then you do a trial balance, then financial reports. And what winds up happening, when you go to do this, you want to do it all at the end so that everything is done at the same time. Okay? All right. So you have to determine what are the adjustments made. So basically, where are we now? Whatever we have unadjusted balances. Then we make adjustments, and we make them based on where do we need to be. How do we need to make it correct for the financial statements? Okay. So here, this is so notice here, this is an unadjusted trial balance. Okay. So this is before. Notice the name of the company, unadjusted trial balance, point in time, right? So, for example, we need to decrease for supplies used up in December, decrease for prepaid rent used up, right? So you should take a moment, stop here and read these. I'm not going to read them all to you, but read them. And then as we go through, these are the things we're going to do in this chapter so that you see them, okay? All right, let's take a look at this first one here, okay? All right, let's say, okay, so of the $600 in supplies previously received, $250 remain on hand at the end of the month. So what happens is we have, this is what we had now. Now we only have $250 left, so we need to make an adjustment. And what that means is we're going to lower supplies by $350, and we're going to recognize it as supplies expense. And so where do we need to be? Supplies, the asset account is $250, supplies expense $350, and it'll look like this. Okay, so we're going to lower our asset supplies, and we're going to have supplies expense. Remember, we're increasing an expense, we're going to lower net income, right? This is what the journal entry looks like. It's an adjusting journal entry. We recognize the expense of $350. We lower the amount of supplies because we used them up, right? And notice, here's what's happening. We had 600. Notice, you see how it says AJEA? That's adjusting journal entry A. 350 bucks. Now we have 250 left in our supplies. Our supplies expense, it increases with the debit. We go AJEA, so they match up. So this one matches that, so we know, and our adjusted balance is now $350. All right, folks, that's part 1 from chapter 4. We'll be back with part 2 in just a moment.